Welcome to Finance Clips, where we make complex financial topics easy to understand. Today, we are discussing debt refinancing made easy. Say goodbye to high interest rates. Debt refinancing, a term you've probably heard, but what does it really mean? Simply put, it's the act of replacing an existing debt with another under different terms. Now, you might be wondering why anyone would want to do that. Well, it's all about those pesky high interest rates, which can make your debt heavier than it needs to be. Imagine carrying a backpack filled with rocks up a hill. That's your debt. Now, imagine if some of those rocks were replaced with feathers, making your load lighter and your climb easier. That's what refinancing does. It can potentially lower your interest rates, making your debt easier to manage. So, if you're feeling weighed down by high interest rates, refinancing could be a viable option for you. Stay with us as we delve deeper into how you can refinance your debt effectively. Debt refinancing is not a magic wand, but it is a tool that can help manage your finances better. Now, let's delve a little deeper into understanding what debt refinancing really means. Debt refinancing, in simple terms, is the process of replacing an existing debt with a new one. You might wonder, why would anyone want to replace one debt with another? Well, the answer lies in the interest rates. Often the new debt comes with a lower interest rate, which can ultimately help ease your financial burden. Think of it this way. You've borrowed a large sum of money at a high interest rate. Over time, you realize that the interest is eating up a significant chunk of your monthly budget. This is where debt refinancing comes into play. You take out a new loan, but this time at a lower interest rate, and use it to pay off your old high-interest debt. Here's an illustration. Let's say you have a loan of $10,000 at an interest rate of 10%. You're paying $1,000 a year in interest alone. But if you refinance this debt with a new loan at, say, 5%, your annual interest payment drops to $500. That's a saving of $500 a year. But remember, refinancing doesn't erase your debt. You still owe the original amount. It just changes the terms of your debt, making it easier for you to manage. So how does one go about this process? Typically, it involves shopping around for a new loan with better terms. You'll have to consider your credit score, current financial situation, and the terms of your existing debt. Once you find a suitable loan, you use it to pay off your existing debt, and voila! You've refinanced your debt. Now that we know what debt refinancing is, let's discuss how you can do it. Refinancing your debt involves a few key steps. It's just like making a journey, and every journey begins with a single step. So, let's start our debt refinancing journey together, shall we? Step 1 is all about analyzing your current debt. You need to know exactly where you stand before you can plot the best course forward, so roll up your sleeves and dive into your financial records. Make a comprehensive list of all your debts, including credit card balances, personal loans, student loans, mortgages, and any other obligations you might have. Be sure to jot down the balance, interest rate, and monthly payment for each one. This will give you a clear snapshot of your current debt situation. Once you have a clear picture of your current debt, it's time to move on to step 2, researching your options. This step involves a lot of homework, but don't worry, it's the kind of homework that can save you a lot of money in the long run. Research different financial institutions, their loan products, and the terms they offer. Remember, the goal of refinancing is to secure a loan with a lower interest rate or more favorable terms than your current debts. So, look for options that can deliver on that goal. Step 3 is all about comparing terms. Now that you've done your research and have a list of potential options, it's time to compare them side by side. Look at the interest rates, repayment terms, fees, and any penalties or charges associated with early repayment. You might also want to consider the institution's reputation and customer service. Remember, the devil is often in the details, so read the fine print carefully. After you've compared your options and found the best fit, step 4 is to apply for new credit. Now, this step might sound a bit daunting, but it's just a matter of filling out an application form and providing the necessary documents. The lender will review your application, check your credit score, and, if everything checks out, approve your new loan. Once approved, the lender will pay off your existing debts, and you'll start making payments on your new refinanced loan. Now, it's important to remember that refinancing isn't a magic bullet. It's a tool that can help you manage your debt more effectively, but it requires discipline and commitment. Once you've refinanced your debts, it's crucial that you make your payments on time and avoid taking on new high-interest debt. The last thing you want is to find yourself back at square one. When you're dealing with debt, it's easy to feel overwhelmed. But remember, you're not alone. There are resources and professionals out there who can help you navigate the refinancing process and make informed decisions. So, don't be afraid to reach out and ask for help if you need it. And that, my friends, brings us to the end of step 4 and the conclusion of our debt refinancing journey. It may seem like a lot to take in, but take it one step at a time, and before you know it, you'll be on your way to a more manageable financial future. With these steps, you are now ready to start your debt refinancing journey. So take that first step, and remember, every journey, no matter how daunting, is made easier with a clear path and a plan to follow. Refinancing your debt can bring numerous benefits. That's a statement that may have you wondering, what exactly are these benefits? Well, let me tell you. Firstly, debt refinancing can lead to lower monthly payments. Imagine the relief of seeing a smaller number on your bill each month. This happens because when you refinance, you're essentially replacing your existing debt with a new loan, preferably one with a lower interest rate. As a result, your monthly payments may decrease, freeing up some of your hard-earned money for other expenditures or savings. Secondly, debt refinancing often results in reduced interest rates. High interest rates can feel like a heavy burden, continually adding to your debt pile and making it seem like you're running in place. When you refinance, you're seeking out a loan with a lower interest rate, which means you'll ultimately pay less over the life of the loan. It's a strategic move to help you get out of debt faster. Thirdly, debt refinancing can lead to an improved credit score. Your credit score is a key indicator of your financial health, and maintaining a good score can open doors to better financial opportunities. When you refinance and manage to maintain consistent, timely payments, it can reflect positively on your credit history. Over time, this can lead to an improved credit score. Moreover, debt refinancing can provide a sense of financial control and predictability. By consolidating multiple payments into one, it simplifies your payment schedule. You'll have one fixed payment to make each month instead of juggling several, making it easier to plan and budget. Lastly, debt refinancing could potentially unlock equity in assets. For instance, refinancing a home loan could allow you to access the equity in your home for other financial needs or investments. In a nutshell, debt refinancing can lead to lower monthly payments, reduced interest rates, improved credit score, simplified payment schedules, and access to equity. These benefits make debt refinancing an attractive option for many people in debt. So if you're looking to take control of your financial future, debt refinancing might just be the strategy you need. While debt refinancing has its benefits, it also comes with its own set of risks and considerations. Now let's pull back the curtain on the less glamorous side of debt refinancing. It's not all about lower interest rates and easier monthly payments. There's more to the story. First up, potential fees. Refinancing isn't free. There can be a myriad of costs associated with it, like origination fees, application fees, and closing costs. These expenses can add up, and if you're not careful, they might even outweigh the benefits of a lower interest rate. It's essential to crunch the numbers and ensure that the savings from a lower interest rate will indeed surpass the costs of refinancing. Next, we have longer repayment periods. Sure, smaller monthly payments sound attractive, but they often come with a catch. You see, when you refinance, you're typically extending the term of your loan. This means you'll be in debt for a longer period, and even with a lower interest rate, the longer you're paying off a debt, the more interest you'll end up paying in the long run. So, it's vital to consider whether you're comfortable with potentially being in debt for an extended period. Then we have the impacts on credit scores. When you apply for refinancing, the lender will perform a hard inquiry on your credit report, which can temporarily lower your credit score. Now, this isn't a major drop, but if you're planning on applying for other loans or credit cards soon, it's something to keep in mind. Additionally, if you're refinancing a loan that you've had for many years, it could shorten your credit history's average age. This can also have a negative impact on your credit score, so it's important to think about how refinancing might affect your credit health. And lastly, but certainly not least, there's the risk of falling into a debt trap. If you're not disciplined with your finances, refinancing could lead you into a cycle of continuously refinancing your debts, each time accruing more fees and extending your debt period. It's a slippery slope, and it's critical to approach refinancing with a clear plan and strict financial discipline. So, there you have it. Potential fees, longer repayment periods, impacts on credit scores, and the risk of falling into a debt trap. These are some of the risks and considerations that come with debt refinancing. While it's true that refinancing can be a useful tool to manage your debt, it's not a magic wand that will make your debt disappear. Refinancing is just another financial tool, and like any tool, it should be used wisely and with caution. It's crucial to weigh these risks and considerations carefully before deciding to refinance your debt, because at the end of the day, the goal is not just to get out of debt, but to build a financially secure and prosperous future. We've covered a lot of ground today on the topic of debt refinancing, so let's take a moment to recap and solidify the key points we've discussed. Debt refinancing, in its simplest terms, is the process of replacing an existing debt with a new one, often with more favorable terms such as lower interest rates. It can be a powerful tool for managing your financial obligations, because when done correctly, it can lead to significant savings. We delved into understanding the concept of debt refinancing. It's not just about swapping one debt for another, it's about making strategic decisions that can improve your financial health over the long term. It involves evaluating your current financial situation, researching potential lenders, comparing rates and terms, and making an informed choice based on your individual circumstances. Then we discuss the steps to refinance your debt. It starts with a clear understanding of your current debt situation. What are your outstanding debts? What are their interest rates? Then comes the research part, where you identify potential lenders and compare their offerings. Following this, you apply for the refinancing loan and, if approved, use it to pay off your existing debt. The final step is repaying your new loan under the terms agreed upon with your new lender. We also highlighted the benefits of debt refinancing. The potential to lower your interest rate is a major one. By securing a lower rate, you can reduce your monthly payments, freeing up cash for other financial goals. Additionally, debt refinancing can help streamline your finances by consolidating multiple debts into one easy-to-manage payment. However, it's not all sunshine and rainbows. We also touched on the risks and considerations in debt refinancing. It's important to remember that refinancing your debt is not a magic bullet. There are costs associated with the process that you need to factor into your decision. Plus, if you extend the term of your loan, you might end up paying more in interest over the long run, even if your monthly payments are lower. So there you have it, a crash course in understanding debt refinancing. We hope this has demystified the process and given you some valuable insights to help you make informed decisions about your financial future. Remember, there's no one-size-fits-all solution to managing debt, but with the right knowledge and tools, you can make the best decision for your financial future. Thank you for joining us on Finantax Clips. Don't forget to subscribe and share our channel to help others navigate their financial journeys.